Good afternoon once again, and we hope you enjoyed your lunch break and, of course, the chance to network and connect again with all your industry colleagues and perhaps make some new connections as well. We hope you have been learning a lot so far, and here we are back again looking at starting up with the next session. So the session that is going to be happening right here, right now in ballrooms A and B is entitled Unlocking Clean Energy Investments in South Asia, Addressing Credit and Forex Risk. For this, I'd like to introduce, firstly, of course, our moderator for the discussion, IEFA's Sustainable Finance Specialist, Saurabh Trivedi. The stage is yours. Saurabh is joined on stage by esteemed panelists for this session, Lasitha Pereira, CEO at Green Guarantee Company, Harald Hirschhofer, Senior Advisor at TCX, Akhilesh Tilotia, Distinguished Fellow at InfraVision Foundation. And the panel is rounded off with Dhruba Purkayastha, Director at Council on Energy, Environment and Water, India. Ladies and gentlemen, quick reminder that your questions for the speakers can be submitted to the session Q&A via Hoover, and also a quick hello to everyone joining us online for this conference. Over to you, Saurabh. The time is now yours.
Thank you so much. Greetings to everyone joining us today, both in person and online from around the world. I hope those are here enjoyed their lunch. So welcome to our panel discussion on unlocking clean energy investments in South and Southeast Asia, addressing credit and forex risk. I know there has been some discussion in one of the previous session about these topics, but now we are doing a deep dive into these two issues. So as we all know that the global transition to clean energy is at a critical juncture, particularly in emerging markets. To achieve our climate goals, we need to dramatically increase clean energy investments in these economies. The scale of this challenge is staggering. Estimates suggest that developing countries need at least $1 to $3 trillion annual investment by 2030 for clean energy investment alone. This massive requirement is essential not only for climate mitigation, but also for sustainable economic growth in emerging economies. However, this crucial flow of capital faces two formidable obstacles. One is credit risk, and the other is foreign currency risk. These factors dramatically inflate the cost of capital, creating a significant barriers in investment in clean energy infrastructure in emerging markets. These challenges that we face are multi-layered, involving risk at global, national, and project-specific levels. At the global level, we need to address how capital flows across boundaries. The cost of money matters a lot, and the country risk adds to the cost of capital even before project-specific risks are considered. At the national and project levels, credit risk forces project developers in emerging economies to pay significantly higher interest rates compared to those in the developed countries. Recent data points a very stark picture. For instance, industrializing emerging economies paid on average 8% more per year than G7 countries in international bond markets. For renewable energy projects, the credit risk premium in emerging markets can be as high as 5 to 10 percentage points above comparable projects in developed markets. In some African countries, the cost of debt for renewable projects can exceed even 20% compared to just 3 to 5% in Europe and North American countries. This risk premium can make any otherwise viable projects unprofitable, severely constraining clean energy development in these regions that need it most. On top of it, foreign currency risk further compounds these challenges. The data here is equally concerning. Hedging costs averaged 5.7% per year in 2021-2022 for major emerging markets. Currency fluctuations can increase the cost of renewable projects by up to 30% in some of these markets. And the foreign currency risk alone can add 1.5 to 2 percentage points to the cost of capital for renewable energy projects in emerging economies. The combined effect of these risks on project viability is profound. In 2021, the weighted average cost of capital for a utility-scale solar project was 10.6% in emerging markets. And compared to just 4% in the EU, a staggering 6.6 percentage point difference. This can translate to millions of dollars in additional financing costs over the life of the project. What is particularly concerning is that a significant portion of this high capital cost represents an excess risk premium, essentially an overpayment of perceived risk that often do not materialize. This overpricing of risk is a key obstacle we must overcome. Today, our distinguished panel will discuss the existing risk mitigation solutions and also explore emerging solutions to address these challenges in cost-effective manner. We will discuss strategies for scaling up risk mitigation tools which are already there, addressing regulatory hurdles, and examine the role of DFIs, central bank, and global north economies in underwriting these instruments. Let me briefly introduce our esteemed panelists, starting from my extreme left, Dhruva Prakasta. He is currently the director at the Council on Energy, Environment, and Water. He is an ex-World Bank, ex-IFC, and have vast experience in climate finance. Next, sitting beside Dhruva is Akhilesh Telotia. He's a distinguished fellow at InfraVision Foundation. He is an author, and he has worked with National Investment and Infra Fund, NIF, which is like a sovereign wealth fund for India. Beside Akhilesh, we have Harold Hirschhofer. He's a senior advisor at the Currency Exchange Fund, that is TCX, and he has also worked with IMF for several years. And finally, we have Lasit Pereira, who's a CEO and co-founder of Green Guarantee Company. And prior to Green Guarantee Company, he was the CEO of Guarantco. Just another reminder for the audience that all the questions will be only through the Hua app. So I kindly request everyone to post your questions there only, along with whom they are directed to. And we'll also address these after the moderator's questions are over. And to keep the session running smoothly, we won't be accepting any questions via hand raise or online chats. So as we delve into this crucial topic, I encourage our audience to consider the transformative impact that addressing these risks could have on the global clean energy deployment and climate change mitigation efforts. I would also request my speakers to keep our responses to under 3 to 4 minutes so that we can wrap up in time for the tea break that follows our session. So let's begin our exploration of these challenges and the solutions that could reshape the landscape. Hello. I'm starting with you, Dhruva. So can you give an overview, like how do large clean energy developers in emerging economies currently manage Forex and credit risk? And what are the risk mitigation strategies that have been most effective for investors, in particular debt investors?
Thanks, Saurav. This session is on credit and Forex risk, right? Let me start by saying, if you're asking how clean energy developers manage, well, most of it is local financing. So if most of it is local financing, you probably do not need to manage Forex risk, essentially. So there are two schools of issues here. One, should you actually look at renewable energy from a Forex risk at the first place? That itself is an issue because there are two schools of thoughts saying you need to develop local financial intermediation and better, and that can get subsequently supported internationally. So that is one, most renewable energy developers in large economies in Asia manage local financing. The second part, if they are exposed to ECBs and then what do they do? If you want the practice, Forex risk is not managed. It's left unhedged. That is what the reality is. It's managed to the extent of maybe 30% of the exposure at max. The third point, limiting within my time, is an issue of trying to think, do you actually need to manage Forex risk? I'm coming back to a basic question. Is Forex risk, depending on where you are looking at it, for a private developer in renewable energy, it's probably better off to have a local currency financing. But if your question is on saying that here is the renewable energy investment gap and therefore capital needs to come in, that is where you started with, then the issue becomes a much more complex in managing quote unquote risk, whether it is credit or forex. Materially does not matter. It's the risk of a country. Now, the simple part is risk of a country cannot be managed from within a country. So that is a point which I keep underscoring, that you cannot manage the risk of you being you with yourself. It is like saying a home loan I have taken and I am the guarantor of the loan that I have taken. It doesn't work. So in simple terms, therefore, the risk of a country as it is measured as a sum total of sovereign, political, credit, forex gets embedded within credit risk. That's an important point to note, that at some level it is the credit risk. If you leave aside very classically old political risks of incontrovertibility of currency, appropriation of assets and things like that, forex gets embedded within the credit risk and therefore can be managed even within that. The problem in developing countries is the forex markets. The bond currency derivative market nexus remains weak. So classically you don't have such solutions unless there is a public intervention towards supporting that. And I will let my friend Harold dwell on that much more than me taking up time over here. Thank you.
Thanks, Dhruva. No, we understand, but if you see the quantum capital that is required, even for the domestic clean energy development, is way beyond. Banks are already stretched, the domestic banks. So I think there has to be done something for the foreign capital to flow into the country, even if it is a large economy like in India, or even if this kind of mechanism that we were discussing can play some kind of a catalytic role to create a very long-term hedging market. So I think that's where I will ask Harold when we deep dive into forex risk. Could you briefly explain TCX's role in facilitating foreign capital flows into frontier and emerging markets? And what types of projects have benefited most from TCX's mechanism? What are the typical costs involved?
So let me perhaps start with a sentence which I heard yesterday. There were some workshops also on JETP, just and fair transition, right? And one of the panelists there said, you have to create mechanisms which on the one hand ensure a social stability, social safety net, and at the same time allow you to speed up and achieve that at scale, because we don't have so much time left to achieve the climate targets, right? So, and that made me really think, and I think that is one of the themes also of the TCX work, because TCX was started in 2008, and our role is really to take away the currency risk from the borrowers, in particular in the low-income countries. And so since 2008, we did about 15 billion of transactions, a lot of it in SME financing, microfinance, and increasing amount also in distributed energy, with more than 4,500 transactions. So based on this experience, right, we have now developed some proposals for the G20, to which I will come later. But I think the role of TCX is essentially to be a catalyst of market growth, to bring in private risk capital into taking currency risk away from the borrowers in low-income countries. As long as you need external savings, because the domestic savings are not enough to finance all the growth and investments which we need in the next 10 years, 15 years, you need external savings. And as soon as you need external savings, you have a currency risk, because domestic projects usually receive revenues in local currency, and we have heard that before the lunch session. And then if they get financed in external currency, in foreign currency like US dollars, Japanese yen, euros, you have the currency risk. And so TCX was started in 2008 to create a substitute for currency risk markets. As Truba said, there are in many of the low-income country currencies, there are not insufficient hedging markets. So we have a balance sheet which has about 1.5 billion in capital. And with this 1.5 billion, we take a diversified portfolio of currency risk. We have positioned about 60 currencies. And by taking, we work typically with development lenders like Asian Development Bank, IFC. If they issue a loan, say in Indonesia, for a solar plant, they could hedge with us. Indonesian rupees, we provide hedging facilities, 20 years, 25 years fixed rate, ticket volumes up to 200 million. And this is a proven business model which we are now trying to upscale. And so that's the way. Diversification, proper risk pricing is the tools really to take away the currency risk from the borrowers and bring it into international markets.
Thanks, Harold. I think TCX has been phenomenal in developing the currency market for the countries whose currency are non-tradable. So that has been phenomenal. But I think the next question is about the scaling up. So what are the specific challenges, as a follow-up for you, Harold, that TCX is facing in providing FX hedging for these non-delivery currencies in South and Southeast Asian economies? And how do you address those?
Yeah, first of all, if you just take the ASEAN region, you have very diverse countries, and you have a country like Singapore or Thailand with very sophisticated financial markets already, and then you have other countries on the other spectrum where you have hardly any hedging markets, and you need to create that. So when we entered this area, one of the main challenges which we faced at the beginning was really how do we price that risk in these countries where you had not even the most basic markets, right? And there we used tools like macroeconomic models to assess risks and price the risk. So all that is completed now. We offer pricing in all these currencies in the region here, as I said, up to 20, 25 years fixed rate. Another problem is definitely on the capacity building side. When I naively joined TCX now 17 years ago, I thought if we have a supply of instruments, the demand will follow. I have a great instrument, people will come to me and buy it. But the problem is you can only appreciate insurance or guarantees or swaps if you understand the risk. Many developers or even government officials do not sufficiently understand the risks. So we need to invest in capacity building. I think later you'll give me an opportunity to talk about some of our proposals. Another challenge is perhaps a little bit more sinister because you have conflicting interests. Some people, you need to look, if you build a solar plant, you have a horizon of 20 years, 25 years ideally. But many people who are decision makers have a much shorter horizon, and they try to maximize revenues or maximize their profitability in the short run. They don't have this long run perspective. That is a problem when you're trying to hedge these cash flows. And another challenge is certainly still that if you talk about very large scale projects, that sometimes you don't have, it's the capacity which we need to address. But I would say it's mainly a lot of capacity building. One needs to address the incentives. Yeah, and one, affordability, right? Our instruments work, we're trying to price the risk as we see them emerging. So each deal is priced on a risk, we call it risk reflective basis or market reflective basis. If a market would exist, they would price it probably at that level. That means affordability is a challenge, because if you are in a high risk country where institutions are weak, macroeconomic policies are unstable, perhaps a large exposure to climate risk, then you have very high interest rates. And then even very well formulated projects have very high financing costs, and I think that's another access challenge.
Thanks, Harold. Now I will move to Akhilesh. Let's see, his idea is addressing some of these challenges. So, Akhilesh, in your policy paper that you wrote during the India's G20 presidency, you proposed an ecosystem of long-term central bank swap arrangements with specific currency covers for green investments involving the IMF, BIS, and G20 nations. So can you please explain that mechanism? And also, just to add to that question, is like, which are the suitable countries to adopt such a mechanism?
Thank you for having me here. And let me start from where Dhruba ended, that you cannot be you and insure yourself. And I think if we look at the model of where the forex risk today resides, it's either at the project level, at best in India, at the company and or the promoter level, or it remains within the banking or equity investment ecosystem. Exactly to the point that Dhruba made, these entities and these economic actors are not in a position to take on that risk. What is also clear, and which is something that you mentioned in the beginning, is that given the sheer billions and trillions of dollars that are required both in India and across emerging markets, is that this is not just a question of the local financial ecosystem being in a position to finance all the climate-related investments. So you will have foreign investors coming in, because both there is an important opportunity here, as also, and that is especially true in the case of mitigation, but also there is an inherent requirement, whether it is for mitigation and or for adaptation, that this type of investments take place. So what you need to do is to introduce a new character into the entire equation, a character which can then begin to take that risk. So the idea that has been proposed as part of the G20 policy paper that you mentioned is to think about two central banks coming together, one from the global north and one from the global south. And I'll start with 1:1 and then make it many to many, such that the currency risk of the emerging market can then be parceled away to a larger economy, which from where the investments in the green ecosystem are beginning to come through. Now, to go back to the point about saying that you need a third party which has both access and availability of the foreign currency, which can be given to the investor at the end of the period when the investment term for the investor is over. Where can you find that? Can you find that in the market? In many cases, it was found that countries like India still have very deep markets for forex hedging, let's say 5 years out, maybe 10 years out, increasingly in the 15-year horizon also. But the longer that you try and go, for many economies, for most economies, you do not find that market present. In that context, we looked around to see how is it that these long-term risks have been mitigated in different segments. And after the great financial crisis in 2008, the G7 countries came together and created a system of central bank swaps amongst themselves, which was more to meet the liquidity requirement, that if there is a run on any currency, which then requires to support itself with, let's say, dollars or some other currency, then some of the central banks are standing guaranteed to say that, hey, this currency and or this country will be protected. This is something that has started to happen not just from a liquidity perspective, but also general access to currency and also from an investment perspective. While the US Fed created this network of ecosystems for swaps after the GFC, the PBOC in China has also been taking lead in creating a large number of swaps between yuan, renminbi, and a bunch of other currencies. So the idea that we proposed and put forward was to say that specifically, given that you need large amounts of foreign capital to come in, can you create a set of institutional arrangements between the central bank of a receiving country or a country attracting green investments and one of the G7 entities, and then assure availability to investors at a particular price point that this currency will be available, the hard currency will be available, which goes back exactly to the point that you started the conversation with, is that the realized depreciation in many currencies on an ongoing basis, when we'll come back to tail risks maybe eventually, on an ongoing basis, the risk that is priced in by the markets is significantly higher than the real risk that eventually emerges. In the context of India, which has changed over the last few years, but historically, if the Indian rupee would have depreciated about 2.5% or 3% on an annualized basis, the typical hedging cost would be in the range of 4 to 5%. These 200 to 300 basis points can be a very material delta, especially if the industry is very mature. As you're beginning to talk about debt and or InvIT-like cash flows, if you have a 200 to 300 basis points extra cost of capital, the value that you can derive after having created a project from greenfield and making it very, very viable, you begin to leave a lot of value on the table for a risk which is only a perceived risk and not a realized risk. So that was a broad architecture. Happy to get into details in due course, but that is something that has been ideated. There have been a lot of conversations and engagements on making this a reality. But this is, as Harald, with his 17 years of experience, said, is a work in progress.
Thanks, Akhilesh. Just one additional question, like, what is the feasibility that you think these central banks in the global north and global south to enter into this kind of arrangement, especially for very long term?
So there are many aspects to it. One is the element of precedence. The idea that there are cross-currency swaps between central banks, that precedence exists. Then becomes the question of saying, why should they do it? Is it in the mandate of the central bank to do it? For many central banks, the typical mandate will be either one or two, which is largely with respect to inflation in their local economy, and or in some cases dual mandate of saying employment. But some of the larger banks also have macroeconomic stability as one of the key mandates that they need to solve for. It may not be among the primary mandates, which is typically inflation and employment in some cases, but macroeconomic stability and financial system stability is an important component of many central banks' mandate. If given whatever we understand from climate science, the entire aspect of climate can be destabilizing both from a physical perspective and eventually maybe a migration perspective, and maybe some countries can begin to face macroeconomic financial challenges because of climate. The whole idea of this becoming a macroeconomic stability issue is something that central bankers can and should consider. Which takes us to the third point. Is this something that you can impose on a central banker? Can you do a G7 government to government engagement and then say, hey, this is a good idea, if at all this is a good idea, and then can you ask central banks to say that this is a swap that you need to enter? That is where the independence of a central bank comes in. Central bankers have to make their own decisions. So in context of many of these conversations, many of these topics come up. Again, climate investments in many economies is going to be a proportion of all the flows that will come into that economy. Most emerging market economies will have large remittance inflows, different types of export-based inflows, will also have a lot of different types of other investments taking place. This was specifically designed and defined in the context of climate investments and to kickstart the local ecosystem of climate investments. Once that begins to take place, you will begin to see a local economy around that ecosystem to develop. So I don't foresee this becoming the one catch-all solution, but this is more a demonstrative solution where foreign investors also get a sense of saying that, hey, this is a stable economy, this is backed, this is where these are the type of investments. So this is more signaling in nature rather than completely taking away the entire risks.
Thanks, Akhilesh. We hope that some action we can see after the COP, maybe. Just forwarding that point to Dhruba and after Dhruba to Herald, adding like just the question, like what is your perspective on the role of central bank in FX risk mitigation for green projects? Do you think it should be the new duty of central banks to manage this risk from the climate risk management perspective? Akhilesh has answered it partially, but I'm just looking whether it is a breach of central bank's monetary policy and then they're entering into fiscal kind of a domain.
Look, it's a complex question, Saurav. Look, a country cannot punt on its own currency. So whichever way you want to look at it, you are not able to get the central bank to do it. It can do it on a bilateral arrangement, but it will become very difficult because at some fundamental principle, it is about a country taking a call or taking a position on its own currency, which is, I think, which defeats the purpose of central banking. One. Just to add on here from what I'm hearing from Mr. Tilotia, Harold, the problem here is we have, and let me now create two parts to it. There is an underlying assumption that we need capital to go in to from OECD countries to EMD countries, and that is the premise under which we are discussing. Okay. Now, if that is the premise, then we are faced with a very wide range of cost of debt. I'll give you just some broad share of numbers. So the modeled cost of debt, and it's quite close to reality, in Germany is 3%. The cost of debt in Argentina is 44%. Get to Middle East, it's about 16. Get to India, it'll about 13, 14. And this is a model cost pretty much close to reality. There are some distortions which will happen in individual balance sheet cases. The IEA reports very clearly outlines that EMDE cost of capital, well, take it as cost of capital, ultimately it will translate to cost of debt, is 7x times on an average more than OECD countries. But the cost of mitigation of 1 unit of carbon dioxide is half in emerging countries and double that when you do that investment. But what the capital does is, capital still prefers to invest in OECD than to invest in Indonesia. Now, in order to shift that, and while I agree with Harold on the TCX mechanism, but I think you cannot address this with classical finance of risk-return relationship being monotonic in nature. It will need to be inverted. And if you're not able to invert this as a global public good, just to give you an example and give you some numbers, if you were to cover Patagonia, where there are no human beings and only sheep, with solar panels, it will power both the Americas. This is the potential of Argentina. And can we have any global capital going into Argentina today? If we are solving a global problem, is there some institution thinking about saying that this can be done? So if we stick to our normal approach to capital, these risks will remain as stumbling blocks of thinking, and the paradigm shift will not happen. Sorry, but that's the reality.
Thanks, Dhruva. I think judicious allocation of risk is always a question, and that's why we are discussing how it can be improved going forward.
One point to add, and maybe a wrong term. You know, it's often very efficient to think about saying if you are doing well, the economy is doing well, and therefore it needs to be incentivized. And if you are doing better, and therefore the cost of money to you should be lower. But we are faced with the inverse problem. And in this inverse problem, what is alternatively required is socializing the cost of money. And it may actually appear to be counterintuitive, but that is, if you are able to socialize the cost of money, which incidentally IBRD and IDA have been doing it for the last 50 years any which way. That's it. Thank you.
Thanks, Dhruva. Harold, any views?
I think I would rather reserve for the next round, but except safe to say just, if in some currency pairs, currency risk markets are the most liquid markets, swap markets in US dollar, British pound, euro, yen, super liquid. Question is, do we need to understand what lessons can we learn from these markets and transport them to the other currency pairs and see how we can catalyze private sector growth there.
Thanks, Harold. So now, for this round of discussion, we'll discuss more about credit risk and mitigation. Can we have Lasita's slide uploaded? Yeah, thanks. So Lasita, could you provide an overview of the Green Guarantee Company and its funding structure, operational mechanism, and what has been your experience thus far?
Sure, thank you, Lara. Can we go to the next slide, please? So let's start with what the problem is that we want to try and solve, right? And I think we've heard a lot of it. articulated in many of the sessions today, simply which is that if we're looking at meeting the climate finance gap in emerging markets, and I heard several numbers thrown out as to what the size of that gap is, but I'm going to take the one that the United Nations have put as 5.9 trillion, which is that medium-sized blue dot in the middle there. And we look at all the funds that are available in local capital markets, which are estimated around 1.7 trillion. You can see there's an issue, right? So even with all the goodwill in the world, if we were to mobilize all of that capital, and this is just to climate. So imagine no spending on education, no spending on healthcare, right? Just push all that money into climate, we're still not going to meet the gap, right? Now, there is a very immediate solution to all of this, which is that very large green blob there, which is the over $100 trillion sitting in global capital markets. And you think that less than 10% of that is required to fill that gap. Even if we went for the larger number there, and one gentleman flagged, I think the gentleman from the ADB flagged, in one estimate, $12 trillion is the gap. Well, even that, you're sort of touching around just over 10% of that. So why isn't it flowing is the simple answer. Sorry, rather a question. And one of the challenges is, I think, Sarab, you mentioned it in your opening remarks, significant perception around the actual risk that exists on the ground. If you could go to the next slide, please. Oh, you got the power now. There you go. So, how do we measure risk in financial markets? Well, when we're looking at large numbers of money, typically that falls into the domain of the credit rating agencies. So you've got Moody's, Standard & Poor's, and Fitch. And their job is to take a look at something and, as their name suggests, provided a rating. This is the level of risk that we see attached to this, right? Now, I take great pleasure in pointing out to people that when you get a piece of, and we benefit from this, by the way, the Green Guarantee Company has a rating from Fitch of BBB stable. But when we get our piece of paper with that rating, there's a third word on there, which is very significant because it actually indemnifies the credit rating agency. It's a credit rating opinion. It's not a credit rating fact, right? So fundamentally, what we're getting is the opinion, a very reasonable, well-considered opinion, arguably, of an analyst at one of these agencies as to what the risk is there. Well, this can lead to some very unusual results. So let me give you an example. Renew is the largest renewable energy developer in India. Fitch globally rated as a BB minus rated entity, right? So it's below investment grade, which fundamentally is the challenge because most of that $100 trillion plus that sits there is looking for investment grade opportunities. So Renew doesn't qualify as an investable opportunity for much of that money. However, Fitch also own a rating agency in India called India Ratings. They rate Renew as A+, which is a very high investment grade credit risk. So that begs the question as to why one part of Fitch views Renew as a high investment grade rating investment, and another part of Fitch doesn't, right? Now, that drives us to asking us what actually is credit risk. Credit risk is the likelihood of not paying. So you have this dichotomy here where some people are saying, in an organization saying, these guys are great risk, they will pay, and the others are saying, we're not so sure. And fundamentally, that's not credit risk. That's political risk, lots of other risks that are driven into these credit ratings that actually result in a lot of what Darab was saying earlier, which is that the cost of debt is not proportionate, right? And that's fundamentally what we at the Green Guarantee Company are trying to resolve. Our guarantees are investment grade, but we look at what we believe to be the fundamental dynamics of the actual risk we're taking, and we're prepared to provide our guarantee up to 100% to an investor, which is unusual. A lot of guarantors that exist at the moment are not able to provide 100%, but we can. And thereby, what we're trying to do is address that misperception by the investor that a company like Renew, for example, is not a good risk, right? As a consequence of that misperception, just to give you an example, again, Renew can borrow 15 years plus in India. But coming outside of India, it can only borrow for 2 or 3 years in dollars. That's not a way you can finance infrastructure. That's not an affordable way. That is what we're here to try and address as the Green Guarantee Company. We're here to try and help companies like Renew and others access longer-term capital on more affordable terms. We're working on a project in South Asia. At the moment, I can't disclose a lot about it, but a multilateral, a global multilateral is prepared to provide 13 years debt to that project, and we can get an investor out of London who has never done a deal in that country to provide 17 years with our guarantee. So that's actually a situation where we're able to demonstrate the private sector can offer a superior solution to an MDB in that particular case, right? So this is where we have the opportunity to try and make a difference.
Can I just add to that point? Sure. You know, the religion in rating agency or the Bible is very clear. The Bible says that an entity borrowing from within that entity cannot pierce sovereign ratings. So therefore, India being BBB minus, Renew will have to be, no matter how great it is, it will have to be BB. And that's the only way forward.
No, and I understand that, but I don't necessarily agree with the logic.
I also don't agree with it completely, right? But I'm talking about what's written in the Bible.
Renew is either good for the money or it's not good for the money, right? So that's the point.
But Dhruva, just to add on to this point, these rating agencies have been saying for long that we have done away with this sovereign ceiling kind of thing. Of course, that has not been materialized for sure.
No. Sovereign ceiling, no. Sovereign ceiling you can penetrate only when you have backed it up by capital kept outside the country. Because sovereign rating is a combination rating of political, fiscal, credit, whichever way, Forex, a combination of all that. Okay, so yes, you can penetrate. Reliance did penetrate, was the first one. Public sector companies have done it. Public sector companies penetrate because there is subsidiaries which are incorporated in jurisdictions which have better credit ratings. So if you can go and create a vehicle, and your answer to the point of what RBI can do, look at it something like this. If RBI or India were to create a vehicle in the UK, right, and that issues bonds, and then you're actually subscribing to it from RBI's Forex reserve instead of GSECs, what you've done by that is you have created a borrowing entity which can then transfer money into the country, and that cost of money will be lower. So since you asked me what the role central bank can play, it is not in the playbook, but can be done by incorporating an entity in, say, in Europe or in UK. It is possible, yeah. But the sovereign ratings part of saying whether it is a cap or not, no matter what you do, it still remains a cap. Now, whether it is right or wrong, I completely agree with Lasit in saying this is about the world is held hostage by 3 incorporated listed rating agencies who are listed in the market when at the first place they shouldn't have been listed. They're playing a regulatory role. Their job is to play a regulatory role, and they are playing a role of being listed in the capital market. They're creating wealth for their owners. So there you go.
And clearly no lessons learned from the GFC, what these guys done during that point of time. Okay, so Dhruva, this is a slightly different question. So there has been an ongoing debate about the merits of providing this concessional debt versus credit guarantees by DFIs, MDBs. So while concessional debt can make projects bankable in certain cases and generate some returns for the public agencies as well, guarantees reduce certain risks for sure, but also require setting aside capital for contingent liabilities. So do you think that the model like Green Guarantee Company can resolve that issue, or is there something else to be done at the MDB and DFI's level?
No, Green Guarantee Company is a great initiative. I completely support that initiative, but many more are required. So is TCX, but many more are required in that to solve it from the markets. But if your question is, should MDBs take the guarantee route, is partly the question that I get from you. The answer is unequivocal yes, and it has been a yes from the MDB's internal system, IEGs too. But it's just unfortunate it does not happen because the change has to be effected. And why? There are two reasons behind it. One, the user of the guarantee is a bureaucrat in every country. A guarantee to him or her is something bad. And why does he perceive a guarantee to be bad, which I don't know. But the fact is, whether a guarantee does something bad or not, a guarantee is not to be considered as bad because bad credit works for no one. Bad credit is bad for the borrower, for the lender, for the economy in general. So guarantee is not about guaranteeing bad credit quality. Guarantee is about improving or guaranteeing something where you do not have the information today. And tomorrow you will have better information. The MDBs, if they are able to do guarantees in their block of capital which they have, they will at least be able to effect 10x. 9 to 10x is what expected losses will tell you. Global expected losses at BBB levels. They should be able to leverage $1 to not one solar panel, but $1 to 10 solar panels is possible. That's the model in which MDBs could reform themselves to provide. Expectedly, PSL lab might be able to do that, but I don't know so far. But yes, I agree with you. Thanks.
Thanks, Dhruva. Now, this round of discussion will be more about discussing how to overcome the barriers that we have discussed so far, and how can we scale up these solutions like TCX and maybe Green Guarantee Company as well. So starting with you, Harold. So before that, can we have Harold's slide uploaded? So Harold, the question for you is like, given that over 100 low-income economies account for less than 0.2% of all currency trading, and TCX has been crucial actually in developing FX risk hedging markets since 2008. So what are the next steps that public agencies, including government bodies, bank regulators, DFIs, take to scale up hedging mechanism for these markets? And what role do you envision for TCX in this expansion?
Thanks for giving me the opportunity to share with you some of the ideas here. I try to keep it very simple on these 3 points, and because I know that you have heard a lot of information here, and I think the challenge is always to keep things simple. So as I said before, and you mentioned it now, we have very liquid currency risk markets in some currencies and in others not. So what can we do now, for example, in the ASEAN context to catalyze more market growth so that if a borrower from England lends into Indonesia, he takes only the credit risk and can pass on the currency risk if he lends in Indonesian rupiah, and pass on to the international market. So we need to create this currency risk market. So we were asked about 1.5 years ago by the G20 and in the roadmap to come up with some ideas how to catalyze these risk markets. And to simplify, there are 3 points really. The first one is you need to create market participants for these risk markets. You need to, and where are the deepest risk pools right now we have? And these are typically the debt management offices of these countries and national development banks. So you need to build capacities in these institutions to properly manage the risk, to understand the risk, to quantify the risks. It needs to be embedded in national debt management strategies. And in that way, you also improve automatically communication about risk and reduce perhaps wrong perceptions of risk in a particular currency. And you create these players. The second part is in the context of MDB reform. You probably know that there are discussions ongoing what the World Bank and other multilateral development banks should do differently. And one of the arguments is we need to really change the lending practices, because right now, typically the borrower is settled with the currency risk. And this is what Ruba talked about. You know, we need to find a way to bring the currency risk out of the countries, the recipient countries, and bring it into the international markets. Because that relieves pressure on the reserves, makes monetary policy easier, and many, many advantages. But in order to do that, the MDBs have a fiduciary duty, and a duty really regarding their clients who rely on them, to always offer them a choice, that they say, look, you can borrow as you want to finance this project in US dollars, or you can also hedge yourself. We give you a loan where we index the debt repayment to the exchange rate. If your exchange rate is depreciating because there is a pandemic, because there is another global shock, like the invasion of one country into another country, suddenly your interest rate spikes up, the currency depreciates, right? You know, you don't need to carry that risk, so you are hedged. And MDBs have a sophisticated treasury. They can always build into their loan agreements these provisions that they index the debt repayments to the exchange rate. A more sophisticated approach to that, if you want to systemically reduce the debt overhang which we have and the currency risk overhang you have in many of the loan contracts from development institutions to borrowers in low-income countries, you have debt conversion clauses. You can use these debt conversion clauses to introduce more currency indexation in the overall debt portfolio of borrowers. The last point is, and that goes to TCX really, is TCX with its balance sheet has a catalytic role in enabling commercial banks to get into these risk markets. We take risks which commercial banks do not take. We are additional. We have a warehousing function of risk. People bring us the risk. We then store it temporarily, and then we try to sell it on to institutional investors. This big bubble which Lars showed before, these huge trillions, many trillions, some people say 140 trillions, whatever it is. GFANS is one of the association organizations here representing this 140 trillion bubble. Bubble in the sense of Lars. And you know, we help them access that, so we have right now 1.5 billion of capital. We have made in our proposal that we increase our capital to 5 billion by 2030, because that would enable us to achieve a diversification and single currency exposure limit, so that we can do really larger transactions and hedge large transactions. Not only do 20-25 year hedging, but also do 300, 400, 500 million individual deal sizes. So that is important for the larger infrastructure projects. And last but not least, and that's the final point here, we need to address the affordability. And this comes to this famous 100 billion commitment of richer nations under Copenhagen that could play a role there. We need to somehow enable borrowers in low-income countries, which do everything right in their business model, to reduce the costs they face because of macroeconomic risks and high hedging costs. And that has to do, to some extent, also with things they cannot influence at all. Macroeconomic risks they cannot really influence at all, but on top of it, sometimes these are done by past emissions of high-income countries, and we need to compensate somehow for the higher capital costs which these past emissions are causing now in the developing countries. And we have developed, with the European Commission, a guarantee instrument which allows us to price swaps more aggressively. 200, 300 basis points reduction. This is something you mentioned before that could make a difference in many of these particular solar projects. So we are trying to scale that up massively and roll that out in the future. So these are the three points: capacity building, MDP reform, and then scaling up instruments like TCX and making hedging more affordable. Thank you.
Thanks, Harold. Like, we hope that this solution get implemented soon, and hopefully even before 2030. So we don't have to wait so long, because I think we are running out of the time. My next question is to Akhilesh. Again, can you just elaborate on like what kind of action do you suggest for the IMF and global central banks to adopt or even implement the solution that you have proposed? And another added question to that, should we develop a distinct Forex hedging strategies for large emerging economies versus low-income countries?
So thank you. And I think there were parts of your question which you had asked me earlier, which eventually Dhruba and Harald also addressed. Because what we had developed earlier was the 1:1 model of saying one central bank to another central bank potentially. But what you need is, and Harald just mentioned in his slide about MDBs or some entities in the middle which can become a sort of a conduit between a large number of developed central banks and potentially a large number of developing countries. So you can begin to house the sort of swaps that is being considered in one or two large such entities, potentially TCX. And what that will do is not just create a standardized set of documentation that can be done, standardized set of taxonomy on what needs to be done, standard set of jurisprudence as it begins to evolve. It will also bring in the sort of diversification point around currencies, both on the countries which are willing to support and the countries which are willing to take this sort of climate finance, which is backed by a hard currency. So in some sense, the idea that we started out from and where I think Harald has taken the discussion is very complementary, which is to say that you need to create N into N, many to many sort of combinations, and you need to have organizations which can begin to do this. I also wanted to quickly comment on Dhruba's point, and I think it's a very interesting one that he said about that countries cannot and maybe should not punt on their own currency. And I think that's a very, very important point. Having said that, I think countries also need to give to a sense to the market. And this, now when I say that, it is from an emerging market country perspective. Central bankers could potentially, having entered into some of these swaps, if they are willing to underwrite a level of depreciation, for example, I think that is also a very important market signaling mechanism to give a sense that this is how the policy is expected to evolve in this country. Because what is it that you're worried about? You're worried about that in X number of years, 10, 15, 20 years, way deep into the future, some policy choices that this country is currently committing to will come unhinged. So for example, and just to take India's example of a 4% inflation rate plus minus 2% band, and comparing it with, let's say, a 2% average inflation rate that the US Fed is targeting, if you can see that legislatively or through policy instruments, central bankers are committing to a particular depreciation band or an inflation differential band, how do you begin to use that certainty that is available through a policy pronouncement and convert that into the certainty that can be delivered through markets on the hedge side? So those are some aspects that I think need to come to the table. On the inflation side, it has become far more acceptable for countries to have targets. It is not still very acceptable for countries to have long-term views on where their currencies will evolve. But given the sort of somewhat theoretical, but also practically empirical linkages that exist between inflation in one economy versus inflation in another, linking back to depreciation, I think we need to move beyond just thinking about one variable, which countries are willing and able to tie themselves down to, but not necessarily to the other variables. So I think we also need to push some of the agenda forward on that. To your second question, I think that's a very important point, that there are different classes of countries when it comes to their ability to manage their own fiscal plus macroeconomic situations. Indeed, the fact that there are different credit ratings for different countries is also both symptomatic and required, because different countries are able to manage their macroeconomics very, very differently. There are countries which have, even though they are classified as either middle income or emerging market countries, have been in a position to create a lot more stable macroeconomic policies and have been able to consistently demonstrate that these policies have legs and will sustain through a longer period of time. There, and again, I think the word bilateral was used in some cases, so maybe bilateral or small group of countries coming together and creating solutions for those set of countries could potentially be one option. For countries where TCX is, for example, present, which are maybe smaller in nature or which have seen significant variability in the ability to keep policy consistency, you need different types of solutions. So there are different types of ideas that need to be there, different types of solutions that need to be created for different sets of countries. And I think this will also be a process of learning as we go forward, because some of the things that you can begin to showcase in countries which have shown policy stabilities can be replicated by countries which may not have been able to do that now. And so many of these ideas need to bloom.
Thanks, Akhilesh. Let's see if your paper is being considered in the next G20 presidency, and I hope discussion goes forward. It does not stop in a paper itself. So wish you all the luck. Dhruva, you want to?
I just want to kind of compliment Akhilesh's point in saying, yeah, I mean, on second thoughts, it is possible to have the central bank, even if principally that appears somewhat kind of counterintuitive to do so. But you know what? It is possible in Southeast Asia, but may not be for India, because you definitely need capital account convertibility, without which, therefore, if you don't have full convertibility, then that equation doesn't work, because at some level, if the RBI, or particularly for RBI, it will not be possible. So, but just to add to the point that he was trying to ask on the, if you are able to look at what the second round of IMF SDR round, which has been created, which is the 600 billion which has gone in, now the excess SDRs, if you can reach-analyze the excess SDRs into, one, you have the resilience and sustainability trust, and that, if you reach-analyze the SDR, which means monetizing that through the World Bank, and therefore if you are able to create a foreign exchange fluctuation trust, or call it by any other name, that is exactly in the lines which Harold is saying, that you have excess SDRs with the OECD. Now, those excess SDRs have happened because the developing world had to collateralize and mortgage allocated SDRs to borrow whenever the need was there. That is what the SDR mechanism is. Now try and monetize the SDR as it has been done for the Resilience and Sustainability Trust, which then lends not according to income anymore. It lends for resilience to vulnerable countries, which means it may be a high income, but a vulnerable country, but you're getting concessional loan there. So look at that same mechanism and maybe replicate that. You said IMF, I mean, that's the only mechanism that I can think of in IMF. Thanks.
So Akhilesh, you made Dhruva to incline slightly on your side, so that's I think.
Well, I think there is an interesting development of the idea that I think Dhruva has brought to the table, and I think it's worth exploring and maybe potentially writing more and thinking more deeply about this SDR as an idea. Just one very quick point on capital account convertibility, and that's a point that has been mentioned, and which is where, again, I do not foresee these swaps or any instrument that eventually get created for more investment flows to come through to be the be-all and end-all. And in some sense, these will be both time and quantity bound. So there will be a few $100 billion worth of swap which are defined and designated. And to that extent, specific windows can get created to say, hey, to this extent, convertibility is possible. To the extent of that. So you can begin to identify problems and begin to parcel them and keep them very well and sharply defined. So you don't need to necessarily give up on overall policy choices that you're taking about convertibility or otherwise, but for a specific set of things can you do. Again, the idea is to demonstrate that even the emerging market central bank is aware that depreciation is an important risk, maybe is willing to guide the market to a certain amount that it will work towards working, ensuring that that is where the currency will potentially be in the next 10, 15, 20 years in terms of depreciation, etc. So this is more signaling. This is not the only solution on the table and should not and will not cover the entire economy.
Thanks, Akhilesh. I think there has been some discussion going on capital account convertibility in India as well, but not specific to green investment. I think that can be one of the way we can channelize some specific investment. Lasit, so over to you. Do you have any target for private debt mobilization through the Green Guarantee Company in next, say, 5 to 6 years? And what are your plans to scale this product, especially in more difficult geographies?
Yeah, so I think we have an ambition to get to about a $5 billion portfolio, sort of in that sort of 5 to 7 year time horizon that you're talking about. The one thing that gives me a great degree of confidence is that there's been a lot of demand for the product in the market. One of the things that we've designed the Green Guarantee Company to be very specific is we're not looking to create another DFI. So while we have public sector capital that has sort of seeded us and is getting us up and running, the design of the company is fundamentally to transition in ownership to the private sector to scale it in the long term. So either that'll happen through some form of IPO or secondary sale to the private sector in sort of a 10-year horizon is the target for that. So fundamentally what we're trying to do with the Green Guarantee Company is to prove the concept, right? And I think sometimes the old ideas work the best. And I think we spend a lot of time trying to chase these new technologies and whatnot. And the truth is that if it hadn't been for guarantees, all the infrastructure in developed countries wouldn't have existed. The monoline insurance industry, which existed in the 70s, 80s, 90s, was essential to municipal infrastructure markets growing in the US. Problem was they got so good at it, they did their job so well, they eventually put themselves out of business, right? So that's not something we fear as the Green Guarantee Company. Frankly, that would be a badge of honor if we ever got to that point. But our ambition is to scale the business through ultimately making it a private sector driven entity and pushing it through that way.
Green monoline is the way to go. They collapsed in 2008, which is the...
That's because, but the seeds of their downfall were in the early noughties. Because their volume, if you look at their volumes, they were dropping. So they had to go and find new business and ended up doing stuff they didn't understand.
But you need that monoline today for the green investments. A monoline
That's what we're hoping to start, right? Yeah. I mean, you said it earlier, which I fully endorse. We don't need a green guarantee company. We need green guarantee companies. Yeah.
Yeah, monoline has not been touched for almost 15 years. So, but I'm seeing that in some of the papers, it is again being considered for all of these reasons, I think. Dhruva, just to wrap up the moderator round, can you just tell us very specific policy recommendations for central banks and global north economies in terms of channelizing more investment, especially in the context of reducing these two risks?
Some of these two, credit and Forex risk, contributes to higher cost of money for transition and green investments in developing countries. Therefore, in order to reduce this, it's a friction cost, right? If it is a global public good, then, and it becomes cheaper to do so for a global good anywhere in the world. So therefore, you need, apart from green guarantee companies and TCXs, which may be amplified, magnified, scaled up or replicated, that's one set of initiatives. What you also need is a central bank coalition and along with, of course, the political will to create an institutional platform which addresses the region. And by the way, this is there in the IEG report, which basically says that the MDB reforms, and I was hearing Harold talking about the MDB reforms. So the MDB reforms need to change in the manner it works. One is, it needs to do more of guarantees, yes, but how does it do more of guarantees? Because if the MDB says, give you a lending guarantee, or I'll give you a guarantee so that there is another lender which rents, and says, I need a counter guarantee for the sovereign, that it defeats the very purpose, because the sovereign could give its own guarantee at the first place. Now, which means change in their charter. Change in their charter. The second, the MDB is about lending to a country for a country's strategy, following that country's country assistance, country development, country partnership strategy. This also needs to change because guarantees need to work across countries. So that is your fundamental, and Lasit will bail me out here. It's about diversification of risk across the board, and that diversification needs to be done, and the third thing is engaging the private sector not ex post, but ex ante. And what do I mean by ex ante engagement of private sector is do it before after you have already created a lending or an investment in a project or in an association. Then you calculate your crowding in as private capital mobilization. And that's quite a ridiculous formula that the World Bank, ADB, and multilateral, ridiculous formula of magnification that is used. That needs to happen prior to the project operation. These three things. Thank you.
I mean, and just on your last point, I completely agree because, so one of the things we do is we've created something we call the climate deal room. And what we do is we actually get institutional investors into there. We do this virtually and we do it in person, right? And we get developers from developing countries come and present projects that they are going to bring to market in 12 months' time so that those investors can tell them, this is what we need to see you do. This is private sector investors sitting in New York, sitting in London, saying to them, guys, if you do this, then we're going to come and put money in, right? And yes, we need the Green Guarantee Company today. But actually, if we get comfortable with what you're doing, the next time you issue a bond, we might not need the Green Guarantee Company. That's what we're trying to achieve, right? We're trying to achieve that shift in mindset, not the reliance on credit ratings, but the investor saying, I know you now, I know you do what you do, I believe in you, I trust you, I'm going to lend to you. That's what's going to be the game changer, right?
Reduce reliance on credit ratings.
Yeah,
That's
absolutely.
the way to go.
Just on MDB reform, I'm just going to have my little bit on that one, is this as we've discussed, credit ratings, they're a useful tool, okay? Let's not say that they're not. That's not the answer, is not to throw it out. But equally, MDBs have become so attached to AAA ratings that that has become a bit of an albatross around their necks as well, and they need to think about that as well, right? There are a lot of, I don't even think the US government's AAA anymore, is it? AA. So people still rely on the dollar. So that's my point, right? I think you need to think about that as well from the MDB side.
Thanks, Lasit. I think what I can understand that a lot of systemic changes are required, and systematic changes also may be very difficult because these are very old institutions. So let's see how we can push these systems going forward, given the risk that the mankind is facing right now. I've got a lot of questions, but I'm short of time. But we have answered a lot of them already, actually. But there's one question for Harold, actually. This is a very short question, I think. Does TCX provide hedging solutions for equity investors as well? Equity investors.
So, I mean, yeah, I mean, our main instrument is a cross-currency swap and a forward instrument, and these derivative instruments work best if you have very stable cash flows which you want to convert from one currency to the other. If you are an equity investor and you don't know exactly your exit and how much you will realize when you exit, it's very difficult to formulate these instruments and calibrate these instruments so that you don't take potentially additional risks. So we don't do equity, we haven't worked really with equity investors. However, we have been advising equity investors to de-risk the business risk. That means to look, when they invest in a company, look at all the currency mismatches they have on the various cash flows, and to see perhaps some of these cash flows are stable and can be reduced, maximize natural hedging. But really the exit hedging is a little bit difficult. So, but you know, to go back to what I said before, I think one of the things which we really need to do, we need to build capacity of understanding currency risks and how to understand also the instruments of currency risk hedging. I think that is very, very important. And that applies for equity investors and it applies for debt investors. And we really need to start where the big pools of currency risk are sitting. That means in the national debts of developing countries and in the national development banks. So I think that's the priority.
Thanks, Harold. I think audience can actually interact with the speakers and we can discuss that offline if you have any other questions. So just to conclude this insightful discussion, I would like to highlight a few key takeaways that have emerged. Firstly, we have acknowledged that addressing these credit and forex risk requires a multifaceted approach, from global mechanisms to project-specific strategies. There is no one-size-fits-all solution. We have explored promising avenues such as local currency financing and innovative hedging strategies. These tools show potential in managing risk more effectively, particularly for renewable energy projects in emerging markets. The evolving role of DFIs and MDBs has been, I think, a central theme here. There's a clear need for these organizations to move beyond traditional lending and take a more active role in risk mitigation. We also discussed the potential of new financial instruments like liquidity facilities and subsidized soft cost. While these show promise, we have noted the challenges in adapting such complex models to smaller economies. Importantly, we have recognized the need to balance innovative financial mechanisms with sound policy frameworks. The role of central banks and regulatory bodies in this ecosystem is equally crucial, but needs careful consideration. Crucially, we need to address the critical question of who will bear the cost of these hedging instruments, which we have tried to answer a bit, but yeah, I think still there's a lot to do. While the challenge of financing clean energy in emerging markets is significant, so too are the opportunities that it presents. So thank you all for your valuable insights, and let's carry the momentum forward, turning these discussions into actionable strategies for unlocking clean energy investment. Thank you so much, everyone.
Thank you. Thank you very much once again, Saurabh and panelists. Would you kindly rise and just step to the front for a quick group photograph before you ascend from the stage to take your seats. Fantastic. Ladies and gentlemen, that was Unlocking Clean Energy Investments in South Asia, addressing credit and forex risks. Now, in the meanwhile, we are due for a quick, short coffee break. Please feel free to have some coffee or tea and connect with one another. We would also like to thank everyone who's been joining us online via the Huvo app for the live stream of the session. All told, we've had just as many participants joining us online as we have in person with us here today in Kuala Lumpur. We, of course, are here today at the IEEFA Asia Pacific Energy Finance Conference 2024. We look forward to connecting with you once again after you've had your coffee or tea and also networked a little bit more with one another. We'll see you back here in Ballroom A and B at 4:15 p.m. And the next session is entitled The Role of DER and Energy Efficiency to Meet Energy Transition Goals. At the same time, for your information, in Ballroom C, we have a concurrent session ongoing that is entitled Japan and South Korea's Role in Asia's Transition. See you all back here in Ballroom A and B shortly, ladies and gentlemen, by 4:15 p.m. Thank you.